Let's talk about Union Budget 2026, calmly, clearly, and without drama. Because if you go by headlines or social media reactions, you'd think this budget is either a disaster or some kind of anti market move. And both takes are lazy. This budget is not meant to impress you in 5 minutes, it's meant to shape behavior over 5 years. And that's the first thing people need to understand. India today is not a fragile economy that needs constant stimulation. It's also not a reckless economy that can afford excess risk. We're somewhere in the middle, growing but exposed to global shocks. The government understands this. Global interest rates are high, liquidity is tight, capital is selective, geopolitical risk is real, and financial instability travels fast across borders. So, Union Budget 2026 starts from one basic assumption: stability is more valuable than speed right now. That assumption explains almost every decision in this budget. Let's talk about capital expenditure first because that's the backbone of everything else. The government has pushed capital expenditure to Rs 12.2 lakh crore again. And this isn't new. This is the third consecutive year of aggressive capex support. Why does this matter? Because capex does three things simultaneously: it creates jobs, it improves productivity, it crowds in private investment. This is slow, boring, unsexy growth, but it's durable. Roads don't disappear, railways don't vanish, logistics efficiency compounds year after year. This tells you the government is playing a long game. They're not chasing one election cycle or one market rally, they're laying down economic plumbing. Now, let's talk about the most controversial part of this budget: the STT increase on futures and options. People are reacting emotionally, but policy isn't emotional. The reality is this: derivatives trading in India has grown at an insane pace. Retail participation exploded, leverage became normalized, risk taking stopped feeling risky. That's dangerous. Not because people lose money. Markets always involve losses, but because systemic risk builds quietly. When too many participants are over leveraged, even a small shock can cascade. The government is not stupid, regulators are not blind, they see the data. So, what did they do? They didn't ban derivatives, they didn't restrict access, they didn't impose position limits, they simply increased friction. Friction changes behavior without killing markets. If you're hedging genuinely, the cost increase is irrelevant. If you're trading with discipline, it's manageable. If you're churning options daily with leverage, it hurts. And that's intentional. This is the government saying, well, we will protect the integrity of the financial system, even if it upsets some traders. For long term equity investors, this is almost a non event. Cash markets are untouched, capital formation is encouraged, IPO markets remain supported. This is a very important distinction. India wants equity markets to be a wealth creation platform, not a casino. For investors, this means commodity linked businesses with strong balance sheets benefit over time, not overnight. Now let's talk about crypto, because expectations were misplaced. Many people expected either relief or crackdown. Neither happened. And that's actually meaningful. The government is taking a watchful, cautious approach. They're not legitimizing crypto as a preferred asset. They're also not trying to wipe it out. In the context of this budget, crypto falls under the same philosophy as derivatives. High risk speculation is not encouraged. Compliant participation is tolerated. This environment favors long term builders, infrastructure players, and serious capital, not hype driven leverage. Gold, meanwhile, continues to play its traditional role. This budget doesn't fuel a speculative property boom, but it strengthens the fundamentals. Infrastructure improves access, urban development improves livability. That supports real demand, boss, not flipping. This is healthy for the sector long term.